Welcome back, everyone, to the European VC podcast. This is the first podcast episode we do in the new year, and I'm super excited about it because we're going to talk about how climate tech has not died, but only the weak models have. And we're going to focus on what's emerging instead of the old days, so to say. We're now seeing a more serious alignment between industrial families, institutional capital, and long-term system change driving the forces forward. Today's conversation with Jan Hofmann from Viessmann Group and Christian Hernandez, founding GP of 2150, is all about how that alignment actually gets built and why it's accelerating, not retreating. Before we start the show, a quick note. If you're building or running a fund, you know it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. First up, ACE Alternatives. Every fund manager needs clean operations behind the scenes. From fund admin to tax and compliance, ACE handles it all across VC, PE, private debt, and real assets. They're trusted by some of the best investors in the world, and if you want peace of mind and a scale-ready back office, ACE should be part of your stack. Finding deals and managing your portfolio is at the heart of running a fund. Synaptic helps you discover startups before others do, and Portfolio IQ keeps your portfolio data sharp and ready for LPs. Together, they're essential tools for modern fund managers. When it comes to legal, you need a team that truly knows venture. Haynes Boone supports LPs, GPs, startups, and scale-ups across the full fund lifecycle. Smart managers make Haynes Boone part of their stack. We have two at EUVC. Tech Barbecue. Oh my God, who doesn't love barbecue? Europe's startup scene meets the loudest, friendliest family reunion ever at Tech Barbecue. From Nordic founders to global VCs, this is where ideas catch fire and relationships get real. If you're building or backing in Europe, Tech Barbecue is where you want to show up. And hey, if you've got a big fun announcement coming up, want to hit the headlines, or just want to tell your story out, do reach out to us because we'd love to help. And we've got some killer partners to help you get in the right media places. They've helped us land Bloomberg, CNBC, Financial Times, Forbes, and many more for the EUVC Summit, and we'd love to do the same for you.
This was their finest tower.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Let me just first ask you, why do you say that climate tech is not dead, but instead we are just having stronger models than ever before in this ecosystem?
So there is a prevalent meme about the fact that the climate tech is dead. Let's backtrack to climate tech becoming a word in 2020, 2021. Before that was clean tech. So maybe it's an evolution, but for me, climate tech is simply technologies that are better, faster, cheaper, that improve industrial process, that actually generate value, and also happen to do some good for the planet. And that has not abated, right? People still want to buy stuff that's cheaper, faster, better, and are deploying it at scale around the world. If you look at what gets categorized as climate tech by CTVC or others, you actually have seen an increase from last year to this year in terms of capital deployed. We can talk later on about where that capital is going. And if you look at my CRM system and my deal flow, we looked at 2,500 companies last year that categorize themselves as climate tech, which is why they came to us. That's a pretty healthy deal flow. So no, I would not say it's dead. I think it's simply it's morphing and evolving into different categories, and definitely a stronger filter about what will get backed and what will get scaled.
So Christian, I couldn't agree more. I mean, that's why we are on the same page when it comes to investing, so to say. I would add a different perspective that is complementary to Christian's. And I would say that the underlying need for capital hasn't changed. So the need for investing into climate technologies that reduce CO2 emissions, that preserve our planet, I think the need is even bigger than 2, 3, 4, 5 years ago. It's just, let's say, some noise that has found space above the need for these investments. So when you think, for example, of sustainability and all the typical 3 angles as part of sustainability, I think there is some movement around thinking sustainability in a bigger scheme, in a bigger context, for example, including resilience. And when you think about the Central European climate tech investments that we look at Viessmann Group in particular, not only, but in particular, what we see is that the need is still the same, the willingness to go into these positions is still the same. It's just a different, let's say, naming, a different phasing that is used, describing the same need and the same kind of investments.
If we make it super concrete and talk about the pool that is completely undeniable that you're describing here, how do you see customers reacting? How do you see regulation developing? How do you see the infrastructure demands maintaining a very strong pool for climate sustainable, strong solutions?
So what we see on the customer side is that when you think about very central aspects like very basic human needs, there is heat, there is energy, so electricity, all these needs have not changed, but are actually growing. And when you think about how to serve these needs, for example, heat, it's a common denominator that we have in the European Union, but also far beyond that we need to have solutions that are sustainable in the long term. And now coming back to the word of sustainability, in the end, sustainability can also be substituted by resilience. So we need solutions that are able to serve the need of heat, for example, on a very long-term trajectory. And for example, district heating solutions that we are quite active in are solutions that are serving these customer needs, and they are growing heavily. And when you think about what just happened in Berlin a few days ago in the electricity grid and the infrastructure there, this is, let's say, screaming for solutions to protect very central human needs like electricity, and also with solutions that are increasing the resilience of a society. So that goes even beyond climate tech only.
Yeah, and I think that, we talked about the elephant in the room, which is the perception that regulation is going the wrong way. And that is true in one country in North America, where in the last government, we had probably the most aggressive deployment of capital to support the scaling of climate positive solutions. And that has very, very, very quickly been retrenched. And actually, if anything, pulled back. But I think focusing on just the US would actually forget the rest of the world. Whereas, as Jan says, there's still all these needs. And if you look at what happened in the last year, right? So EVs actually accelerate around the world. The UK is actually the second largest market for both Tesla and BYD outside of their home markets. 24% of all cars sold were electric. Solar became the cheapest and fastest scaling deployment of energy around the world. Battery prices were getting slashed down, deployment of solutions. So yes, there is headwinds in one country around anything with the word climate around it, but there's actually significant momentum just simply because it's back to the term I used earlier, cheaper, faster, better to do it that way. You talked about the word resilience, which I think is becoming a portmanteau for climate. So adaptation, resilience, energy independence, all these things are talking about the same thing. I actually went to a defense tech conference recently, and they had 5 companies on stage. And 3 of those companies I would have called climate tech, they called defense tech. So fine, semantics. Let's actually find those companies that can actually support the resilience, the defense, energy efficiency, and costs, and scale them out as quickly as possible. I care less about semantics than I care about them rolling out.
There's 2 specific points I would love to touch on. One is, and both of them fall within resilience, one is energy and one is industry. If we start on industry, could you talk a bit about how the rise of industry as a focus area for climate, at least to me, it seems like where we would have a couple of years ago spoken more clearly about climate as the header, now it seems to be more often industry as the header, the need to change how industry works, the need to digitize, the need to make everything in the supply chains more resilient. All of these topics all fall within climate, but now I'm seeing more phrasings that use the word industry rather than climate. Can you talk a bit about that and both the technologies that you see maturing and coming to the market within industry?
I would like to build on what Christian said regarding semantics. So basically, when you look at the business models that we touch upon with what you just shared, I think not that much changed, but the kind of angle that you look at them has changed. So in some years back, let's say 2020, 2021, the discussions had pretty much semantics and let's say purpose driven. So we wanted to save the climate. And this has been the key driver for business models to be perceived as a good business model. And nowadays, it's much more about the economic opportunity of this business model. And this, I think, is the rephrasing. But if you look at the business models, it's still the monetization of CO2 reduction. It is still about the monetization of energy efficiency gains. So it's pretty much at the same spot right now, but a different angle to the problem and also to the solution. And this comes back to the semantics, as Christian said. What do you think, Christian?
Yeah, this is going to be boring because we're agreeing on a lot of stuff. But so last year out of Davos came out a term I had not heard before called green hushing. So not greenwashing, but green hushing. The notion that people were still taking action to deploy solutions that made industry more energy efficient or companies more energy efficient or reduce their CO2 footprint, but nobody wanted to talk about it. They did not want to be in the crosshairs. I highly expect there will be very little language around climate initiatives at this year's Davos. But people are still buying, people are still deploying, people are still putting industrial heat pumps into their factories to replace natural gas because it makes economic sense. So interesting stat about energy and industry. So everybody right now is talking about the energy demand from data centers between now and 2035, 2040. And yes, we're going to need a lot of energy to actually power our ChatGPT queries, for sure. And that's highly concentrated in a couple different nodes, Northern Virginia, Ireland, Sweden. The rest of the world, the largest load of energy demand that will be needed between now and 2035, 2040 actually comes from the electrification of industry. The current grid cannot support it. The business case is there, so the demand is there. So that's number one. And it's like 3 times bigger than data center energy load. Electrification of vehicles, which is 1.5 times bigger from memory. Electrification of cooling, which actually is still bigger than data centers. So yes, data centers are going to be a driver of innovation around energy sources, energy efficiency, but we need it for the whole rest of the economy around the world.
What's your read on our current trajectory to meet the demand of electrification? Because it's one part is like we've all seen these charts showing that if everything that has been signaled around data center build out was to come to fruition, we would be many X below demand or below supply in electricity. And I think we could do similar charts. I'm personally I haven't checked that out, but I'm pretty sure that we could do the same thing for the demand for energy, for the the electrification of our mobile, our car fleets and our industrial base. So what are you seeing, and do you see the energy grid as a core investment area, investment space for you?
So the grid, I think there's 2 components to it. One is the source of energy, where, I mean, my favorite example is Microsoft recommissioning a nuclear plant in the US for their data centers, 3 Mile Island. Japan actually beginning to talk about nuclear again after effectively being a taboo subject. I think one of the largest recipients of climate tech dollars in the last year was actually nuclear fusion. By the way, if we solve nuclear fusion, we're having a whole different conversation. We're talking about energy abundance and what we do with that. But that's still 10 years away every 10 years. So there's a lot of stuff going on around energy supply, geothermal, which I think Jan can talk to as well. Geothermal is magical. It's the most democratically available source of energy. It's just expensive to get to. And then the second is transmission of that energy from where it gets produced to where it gets consumed. We lose about 30% of electricity from through transmission lines. That is a solvable problem. There's actually some pretty cool companies. There's one, I think, in Germany that actually runs a little robot on top of the cables and actually coats it so that you can actually lose less electricity as you transmit it. There's a couple of others in the US. So there's both the production and the transmission. We've looked at a bunch of transmission solutions. We haven't done anything in that space yet. We have looked at fusion and other stuff. Some of it feels a bit too CapEx heavy for a venture capital of our size, fund of our size. But that is a significant amount of focus across defense tech or energy independence funds or climate tech funds, and something that will be critical. The current grid could just simply not support the energy load that's coming, period. And the speed to build a new nuclear reactor, even a small nuclear reactor, or to build a new hydropower plant is just decades. It just takes way, way, way too long.
I couldn't agree more, Christian. And if I may add a different perspective once again from our portfolio, So as you know, we have Gritec as part of our majority portfolio. And Gritec is basically electrifying the cities. So what they are producing are technical stations where you have, for example, transmission from high voltage to mid voltage within the electricity grid of, for example, Europe. And what we see there is that the whole discussion is not covering the end-to-end perspective. So from electricity generation to electricity usage, but we have kind of isolated discussions. So we discuss electricity usage at the point of, for example, data centers. We discuss generation around nuclear power plants and taboo topic. What we don't discuss is how to bring that all together and how to make sure that our grid is able to connect both dots, so the generation and the usage. And what I think is, coming back to your question at the beginning, we miss two things, not only, let's say, the extent of investment, so it needs more funds like 2150, and second, we miss the integrated view from generation through transmission to the usage.
And you know what the biggest gap right now is? Transformers.
Yeah.
Right now, if you wanted to buy a transformer, you're probably waiting at least a year to get a new one. And I mean, we know how to make these. We know how to make these at scale. So if I had all the money in the world, I would go build a transformer plant. The demand is there. The demand's going to be there for a long, long time. And it's not I mean, literally, we know how to make them. It's not rocket science. We just need more of them.
Let me ask the two of you another question when it comes to climate and industry and the built world. A lot of people are talking about capital discipline and the importance of being able to build in a disciplined way in this category. Can you talk a bit about how we as VCs are coming to grips with that, and how founders that oftentimes come from the pure tech sector is also learning how to play in this sector?
Yeah. So right now, the hardest place to be in climate tech is raising a Series B or Series C for building physical stuff. And by the way, I don't think you can be a climate tech investor without investing in some physical stuff to replace bad physical stuff, along with software, along with low capex stuff. Just capex. The meme that VCs don't like hardware, but you need to build some of these physical stuff. Therefore, you'll need a factory. Therefore, you'll need capital infrastructure. What we spend a lot of time with our founders doing, especially when we look at the investment initially, is how much capex are they going to need, and where is that money going to come from? And ideally, the answer is not from my money. It shouldn't. Equity is a very expensive part of the capital stack. At which point do they become bankable so they can get financing, non-dilutive financing from, be it a grant, be it a bank, be it a financing organization. So just to put a metric to it, across our portfolio, for every euro raised of equity, our portfolio has now raised 0.75 cents of non-dilutive funding, and most of that is commercial paper, debt, to go build factories, to have working capital, to go build inventory. In a 5 years' time, I expect that ratio to be completely skewed. I expect to be like 3 to 1, 5 to 1 of debt versus equity. Working with them very early on to understand that capital stack and capital formation needs, probably pushing for them to have a CFO sooner than you would in a traditional pure software company, because this CFO needs to understand capital markets, the structuring of the product, offtake agreements, interest payments and warrants that comes with some of this debt. And that's very different to traditional venture. I didn't think I'd be doing this much structured finance many, many years after my MBA, but it is very much a part of the advice that we have to give the founders and the need for them to scale. And then secondly, on where the capital is flowing on the equity side, a lot higher bar in the last, let's call it 18 months to 2 years on what's getting funded. Yes, of course, team matters the most. Business model matters as well, but also path to profitability is probably something that comes up way earlier in the conversations than it would have back in 2021 when the next round was just around the corner or being preempted.
Yeah, and do you have similar observations?
I do, but I'm not going to copy all what Christian just said. Just in a sentence, I would say it's professionalizing the whole industry, what's going on right now. And it starts with the podcasts, goes through the funds, but also on our end as an investor, I think it covers the whole chain and professionalizes a lot.
Can I ask both of you, and you, Jan, as an LP, and you, Christian, as a VC, What's your take on the current state of VC capability within this part of it, being able to actually meaningfully help build companies that are hardware intensive? Because we're seeing, I think, a lot of generalist VCs being interested in this space, talking about the importance of resilience and doing investments in that touch the real world, the atoms parts of the world. But sometimes I think to myself, are they really as value add as they were as B2B SaaS investors when they all of a sudden have found this investment space as well?
To me, it's a bit like the intersection point between psychology 101 and economics 101. So on psychology 101, everybody is running towards where the money goes. So this is a bit like everybody was running into climate tech. Now everybody is running into defense. And on the economics part, you can only win if you have a competitive advantage. So, and this is why we have invested, for example, into 2150, because it's a combination of people that bring expertise, experience, and the right conviction to the table. And it also holds true for ourselves. We don't go into positions where we do not have competence. And we don't go into positions where we don't bring something to the table that, let's say, brings the company to a next level. And this is, once again, I think, a professionalization of the whole industry. What you said between the line, Andreas, is a bit like, are we going to see VCs, let's say, drying out? For sure. We will also see companies drying out, for sure. But I think that, once again, if you have these kind of pivotal changes, as we have right now, it's just a moment of separation. So who is going to win and who's not?
Yeah, and it's a very different skill set to talk about hardware, right? And the working capital and cost curves. So happens that my partner, the other Christian, his prior career was actually inside industrials, actually inside factory floors, building physical stuff and rolling that out across different geographies. Most people know me as the Facebook guy, but one of my early jobs was building early mobile phones, understanding bill of materials, and going to Taiwan and looking at factories. And so there's some knowledge, not that we're experts, but at least there's some understanding of what it takes. However, we also need partners that can help us, and that's a large part of why we're excited to have the Viessmann Group as one of our anchor LPs for Fund 2. This is a multi-generational group that actually built a massive company out of Germany, and then obviously had a fantastic exit a couple of years ago. The expertise that they have in-house around what it takes, and actually being able to spar with them around some of the things that we're looking at is pretty important. And having somebody kind of inside the tent that's willing to say, that's just crazy, don't even go there, has been pretty critical. And then secondly, it's also understanding the pathway to profitability. So yes, when we invest in a company that's making a hardware, the first unit is going to be insanely expensive. It was made by hand. It's multi-million-dollar piece of kit. At which point does the price start coming down? Is it the 10th unit? Is it the 100th unit? Is it the 1,000th unit for it to be profitable? And we spend a lot of time when we're looking at investments, understanding how they get the cost down. And obviously some of the cost comes down just because you're buying more volume. Some of the cost comes down because you've done it multiple times. And then at which point does it actually start having profitability on a per unit basis? And at which point does it become profitable on a company basis? Actually, I literally had a board this week in which we were talking about their pathway over the next 18 months to increase profitability through better purchasing, better scaling of the manufacturing. That's a very different conversation to a SaaS B2B software board conversation. I will talk about the black swan moment that happened in kind of climate hard tech last year. So overall, VC had a PTSD moment with Silicon Valley Bank. We all spent the weekend literally not knowing if the industry was going to survive by Monday, and we did. Climate tech had a black swan moment with the elections in the US and the withdrawal of the IRA. Billions and billions of dollars that had already been deployed, or so we thought. People had already started building $200, $300 million factories in the US. There's literally shovels are in the ground building these factories. And all of a sudden you show up at the next board meeting and that money is gone. And I know funds that have exposures of like $1 billion, $2 billion, $3 billion across their portfolio, that there is no ability for that individual fund to make up for it. So that is definitely going to lead to some challenges in terms of just some companies dying, and there were some that already died last year, to some funds having significant troubles on both performance and ability to raise again, and then a question mark around this whole sector of the asset class and how it continues. I knew there was a risk, and actually, so luckily we were not very exposed. We had a bit of exposure to IRA capital in the portfolio, but generally we don't back companies that can only exist if grants get given. But if you only could exist if somebody willingly gave you 200 million because you were cool, that's going to create a massive knock-on effect across the whole sector in this year, next year, the year after that.
Let me ask you both to summarize this first part of the conversation in a principle that you think will anchor climate investing in the years going forward.
Don't do it because it's good. Do it because it's good business.
If I should make one as well, it's exactly that. That's how I am feeling, that every single investor that I have come across that are really performing well still and having good traction in their fundraisers, both from the investor side and the founder side, honestly, they're explaining exactly that. Like, and you can say that it's a bit of the greenwashing part, because you do not want to be leading with that in your decks and in your materials anymore.
I think as an investor, it's quite a good moment in time, because prices have gone down on the one hand and quality has increased on the other hand, because you will not have idiots running into the industry because they think it's a good moment to make money, but you have the right people on the spot because they are convinced of doing the right thing with doing good business. So I think it's a very good spot to be in right now.
Which is exactly why VC tends to be inverted. VC returns tends to be inverted with the hype cycles, because you really don't want to be in a hypey market. It's both expensive and there's a lot of opportunists acting in it. All right, now let me ask you, because the next section I want to talk about here is a bit the 2150 journey. And obviously the Viessmann Group has known 2150 for a long time and been following you. And Christian, you've been building 2150. I want to ask you about your journey from Fund 1 to Fund 2, and open this conversation up by asking you to share some of the moments in which the 2150 journey gave you hope in the face of a very tumultuous market.
Yeah, it's been a fun couple of years. So I think we did the first podcast right when we announced Fund 1.
At the time, I think it was the biggest Fund 1 ever raised for venture in Europe.
For climate venture, yeah. So, I mean, we got started in 2021, right? So we started incubating this idea in 2020, closed Fund 1 in 2021. Fast forward to 2025, we ended up closing Fund 2 right before the holidays or early in December. So between Fund 1, Fund 2, and SPVs, we're now at $500 million of AUM, which is honestly beyond my expectations as to where we would be. When we started with this idea, climate tech wasn't even a term yet. We didn't know if the LPs would have appetite for it. We didn't know what level of deal flow we would get and type of good companies. And then kind of just all accelerated. The founders were there, mission aligned, people willing to fund us, like purposely LPs reaching out to us when they found out we were raising. It was a very different market to what happened over the last 2 years, where obviously VC overall has slowed down. Sorry, LP allocation into VC has slowed down. And yet we were able to raise a significantly sized fund. By the time this podcast comes out, we will be announcing Fund 2 of 210 million euros with a very concentrated number of LPs. I think we have 34 LPs. So it's actually large checks from institutional capital and large family offices like Viessmann. So people are doubling down on us, but also on the belief of this space. Fund 1 was 20 companies. Median check was 6 million euros initial check, with then follow-ons. Fund 2 will be the same. It'll be another 20-something companies. Median initial check will be 6 million. That's Series A or whatever letter you want to apply to it, at the point where that company can scale. And we will continue investing half in North America, half in Europe. We're seeing more and more deal flow at our stage coming out of Europe than we did in Fund 1. But we still think it'll have the right mix. And the realization that there are groups out there where actually I reached out to a couple of our LPs as we were going to announce Fund 2. And I'm like, do you want to be included? I mean, we have Novo Holdings, who's a repeat investor from Fund 1. We have Augustinus Foundation, the Nordics, who's a repeat investor from Fund 1. And then we have new pools of capital like Viessmann that have a US pension fund that I assumed would not want to be mentioned. Probably want to stay below the radar. There's the Church Pension Group. It's the pension fund of the Episcopalian Church in the US, a 17 billion AUM fund, very, very active in venture for many, many years. Their answer was, no, we absolutely want to be mentioned. We want to tell the world that we're actually doubling down in this space. And so that actually gives me hope that there's actually pools of capital, big pools of capital out there that want to say, not only does this matter to us, it matters to the people whose money we deploy, and it matters to actually the mission that we have to deploy that capital and return that capital.
What, Christian, does that resonate with you? Is that the point? Are there the points that you would mention when you were to recap the 2150 journey and your commitment to them?
We have a dual role, so to say. On the one hand, we are general partner with urban partners, so to say the roof of a bus 2150, and at the same time, we are a limited partner with the 2150 Fund 2. Why is that? Because we are completely purpose aligned, as you would say. So we are convinced of the same things and we run into the same direction. We as Viessmann have a very clear purpose of why we do things, and what we do is derived from that. And it's a purpose of 3 elements: to co-create living spheres for generations to come. And when you think about the middle element, living spheres, CO2 generation or CO2 reduction, greenhouse gas reduction, is pretty much at the core of it. And we are also very, let's say, aware of our limitations internally and where we need partners. And 2150 is one of these partners who have a very, very strong skill set in this specific space they are active in. And this comes back to the beginning of our conversation. We go along with partners who bring something to the table beyond capital. And in particular, it's competence, it's experience. And Christian, for example, brings both the hardware perspective and the tech perspective. The other Christian brings in particular the hardware perspective. So they are also within 2150 a quite complementary team that we know quite well. So I can fully echo that. But if we now zoom out again, we double down on that space because we see that the problems need to be solved and that it needs to have both mature solutions that we invest into as Viessmann as well, and at the same time, disruptive technological solutions that, for example, 2150 is focusing on. And it will only be solved in the combination of both, with mature, let's say, more hardware CapEx-driven businesses like Gritech, ISO Plus companies that are part of our portfolio, and the more VC-like solutions.
Christian, maybe just to tie a knot on something that Jan mentioned here, the Urban Partners Group, could you talk a bit about the platform in which 2150 plays and how that's a value add to everything you do?
Yeah, because I think when we did the podcast for Fund 1, it didn't exist, right? So Mikkel, our co-founder, had created this real estate private equity group in the Nordics called NREP, most successful real estate private equity group in the Nordics, actually in Europe. Actually also the biggest. The last fund was 3.6 billion euros. And we got incubated inside it, but actually we're purposely independent and separate of brand, of focus. I should not sit on IC of a real estate investment. A real estate partner should not sit on my IC. What we realized during that voyage is that we had these pockets of capital that were all mission aligned, right? We were all trying to make cities and citizens better. And that there was a benefit to actually bring it all together under an umbrella while allowing the strategies to be independent. We effectively rolled everything up into this platform called Urban Partners. It's a 21 billion AUM multi-strategy asset manager with a core focus around how to make everything inside the city wall and everything that feeds in and out of the city more efficient, more resilient, and better for the citizens that live inside it. We do that through real estate in Germany and the Nordics and Poland. We do that through a private credit vehicle that actually teaches others how to do brown to green. We do that through the part that I lead, which is the solution side, the technologies that we back and scale. And we have a bunch of other ideas of things that will come in the future. What I get out of it is access, to knowledge, because these people are actually building, deploying, implementing. 2, a gravitas that I would not have as a 500 million AUM fund, right? We get invited as a part of the formal Danish delegation to COP. We get to be at Davos. We get to be at tables that a VC by itself would not actually get access to. And we show up with insights into innovation, insights into trends that others might not have. And then finally, we get the scale that a platform of this size can actually provide us to go not only pass technologies onto the real estate side that they can deploy, but actually to have them be the test bed that we can then roll out to others. The Urban Partners real estate side is very forward thinking, like literally funds from the US come to Copenhagen to go learn from them. They've developed literally sections of cities. One section in Copenhagen, for example, called Nordhavn, which Bloomberg called the most sustainable neighborhood in the world. We have the chance to work with them to actually ensure that our technologies get deployed early on as these urban regeneration projects are being developed, to make sure they're actually baked in by the time the buildings get built on top of it. But my day job is still hunting, finding, managing, scaling early stage technology companies as a part of Urban Partners.
And I want to double click on the hunting part, because that's one of the things that you've always been very special around, meaning that you are thesis driven. You're not just the magnet for deal flow and then you pick the best that comes in the door, but you really have thoughtful theses built around different spaces. Maybe you can talk a bit about that. And you're obviously European based and European focused, but you do invest globally. So I'd love to hear your take on that and how that distinguishes you from others, how it changes your operating manual, so to say.
Yeah, so this is part of our thesis. I think we're a bunch of like mission-driven, intellectually curious geeks. That's I think the core definition of what a 2150 team member is. So in the early days, when we're incubating the idea of what became 2150, we knew we had a big problem, 50 gigatons being emitted per year. We started drilling down into what actually causes it, which is why we focus on this stage, right? So 50% of global emissions come from buildings and industry. When we got started, 11% of all venture capital dollars was going into those two segments. So right, misallocation between problem set and capital deployment. Within industry and buildings, what actually causes the emissions? Well, number one and number two are cement and steel, 7%, 8%. Between both of them, we did deep dives on both sectors. We now have a number of investments, 2 that have been announced, a couple more that will be announced in the cement and concrete space. We've been looking for steel investments. We don't have any yet. But then what else causes the problem? And then we've been doing these deep dives into other problem sets where we start with the problem, we create a thesis around what technologies could solve it, and then we find teams working in those technologies. Just because we do a deep dive doesn't mean we immediately do an investment. My favorite example is water. We did a deep dive on water. It's a massive global problem for both adaptation, but also mitigation. We keep looking for a venture backable, so venture case type investment in the water space. We haven't found one yet, but at least we know what we're looking for. And we actually very actively share this deep dives with our LPs, with co-investors. We do the work, but we want to teach others about the solutions. We have a fellow VC that we co-invest with quite a bit. We both looked at the cooling space. We did one company, they did another. It's fine. We probably need a dozen of solutions for that problem set. They might compete in the future, but the whole point is we'll do the work and then we'll evangelize about it. We do webcasts, podcasts, blog posts around these kind of deep dive problems. And it allows us to win deals. We won a deal against a very high profile US VC fund, which is much, much, much bigger than us, because we've done the work. We show up educated. We build trust with the founder, and they know that we know the problem, and they don't have to spend slide 2, 3, 4, and 5 of the deck explaining why that specific problem is a big issue.
Now, we just did a bit of a deep dive on 2150. Jan, you're also here, so let's definitely get one for Viessmann as well. It's not so often that we hear from the family offices, and you, of course, do not only invest as an LP, but also are actively engaged. So maybe, just to those that don't know your operating story and how you came to be a family office, touch a bit on that journey, and then tell us a bit about what you're investing in and how you're focusing that.
So Viessmann is a more than 100-year-old German family business, and we will always call ourselves a family business because we are actively engaged in operational activities. And what we do is deeply rooted in why we do things. And this is around our purpose to co-create living spheres for generations to come. And below these 3, let's say, columns, we have defined strategic investment fields. And one of these, for example, is CO2 redundance, CO2 avoidance. Another one is food preservation or water preservation, so pretty much in line with what Christian just said. And below the third one, generations to come, we, for example, go into healthcare and well-being, but, for example, also into defending democracies. So this is what we do in terms of the strategic investment fields. If you now think of a matrix, the lines, so to say, running across that are our strategic, our investment strategies. First, we have majority positions. So we go all in like a typical buyout where we bring something competitive to the table. So for example, where we have a very strong knowledge. Second, we go into minority positions where we have the right partner at hand. For example, in the healthcare context, we have some very strong connections in the German family business sphere, and we partner up to do something good. And then third, we go into what we call ecosystem multipliers. And this is, for example, 2150 or Urban Partners as a total. And what we do there is quite, let's say, a specific solution to a specific problem. Because when you think on a broader scale, we are pretty convinced that it still needs a lot of capital and a lot of solutions to secure this planet, to say it very straight. And it takes both mature solutions, for example, typical CapEx-driven industrial businesses, and the more disruptive tech-driven businesses, usually low CapEx, a bit more techy. And we are very much aware of what we can do and what not, and where we need to partner. And 2150 is one of these partners that brings a specific set of expertise to the table that we don't have in-house, but that we know is needed to solve the problems. So this is pretty much let's say, those are the two dots that are connected between VGG, Viessmann Generations Group, and 2150 as part of Urban Partners.
Can I throw in a question? Because this goes back to a tweet that I sent out when I first met the Viessmann Group, and I tweeted, there is a climate positive exit, the biggest climate positive exit that nobody calls climate tech. And it's a family office in Germany. It's been around for 3 generations or 4 generations. So Jan, tell the story of Viessmann, the company, and how it evolved into this massive family office.
As I mentioned earlier, the family business is around for more than 100 years now. And for many years, it has been at least perceived from the outside as a fully integrated industrial conglomerate. So we had a large, you would say, division or business area called Viessmann Climate Solutions. And this business has for a long time been active in serving a very central human need, being heat, so making your home warm. This is why, let's say, solving central problems is so close to our heart, because it always has been for more than 100 years. And then there was a moment in time a few years ago where the industrial landscape changed a lot. There have been a lot of external factors driving that. I'm not going to go into all the details, but basically it changed the whole dynamic within the industry. And the shareholder family came to the conclusion with the executive board to, let's say, find the right way to live up to social responsibility as a shareholder and make sure that the jobs around within climate solutions will be around in the next few years or even decades. And the best possible solution was partnering up with, once again, a like-minded partner, in this case, coming from the US, being Carrier Global. And in roughly 2 years ago, so the closing was on the 2nd of January 2024, the closing took place. And since then, VGG, Viessmann Generations Group, is the biggest single non-institutional shareholder in Carrier. So we are still very active in delivering heating solutions, cooling solutions globally, and have had what we call a responsibility event. So it was not a cash event, but a responsibility event to stay true to our purpose and use the funds that have been generated to double down on what we believe in. And since then, for example, having these 3 strategies of majority positions, minority positions, and the ecosystem multipliers. And if I may add just one thought about that, what became quite clear is back then it was not perceived as a climate tech divestment or climate tech partnership, but later on, as you said, Christian, people understood that this was something happening in the space, driven by the attractiveness of our industry. And I think it still is. You just have to think around the corner a bit more than it was a few years ago.
I actually think you make a very important point there, Christian, because I think that one of the unfortunate characteristics, I was about to say, of Europe is that we have incredible stories that are untold, similar to what you just said here, Jan. And that is one of my very biggest missions is trying to get some of them unearthed and give them the moment in the sunlight. Now, I want to close this episode with one final question, and that is to both of you to look a bit in the crystal ball and tell me the next decade in European climate tech, what's most important for us to get right?
It's not regulation, and I think we're very good in Europe at trying to solve everything through regulation. It's actually giving a clear lane for innovation and then competition. Yes, Northvolt folded, and there was a lot of press about that. Nobody talked about the fact that the largest gigafactory for batteries got announced that same week in Spain. It just happens to be a CATL factory. And I don't care that it's CATL factory. There's still a massive mega factory making batteries in Europe at employment, jobs, solutions being delivered by a Chinese player. And so everybody focused on the negative. We forgot to mention the positive, or it just got buried, right? So I think, like you said, we need to tell the good stories. And then the hope that and
then we need to celebrate that Northvolt, despite having ended up folding, wasn't a massive bet, and a lot of powerful people and institutions got together to try and make a real moonshot attempt at something in Europe, which I think is just as great a story, if I'm being very honest. And like, I don't know the Northvolt story well enough to absolutely be able to say that maybe we could have actually recovered it or saved it from going the journey it did. I think there are many views on that. But I do think that it is a hallmark of Europe that we too often talk about the bad things when there are actually absolutely incredible angles to it as well.
Yeah, and we need to be bold. And I think that's we are pretty good at cutting people down when they try to be bold. And I think there's a number of a new generation, founders who've been successful who are now becoming VCs or actually becoming angels or becoming doing their next startup, where they actually have the ability to be a bit more chest thumping American style. And you know what? That's okay. Somebody wants to try to insult me in France by telling me I was too Anglo-Saxon because I was educated in the US. I worked for American companies. That's good. Sometimes you need a bit of that hubris and being proud of what you accomplish. And if that leads to success, financial and otherwise, good for you, because you will reinvest it back into the ecosystem through mentorship, angel investments, VC funds. And that's the flywheel that this podcast tries to exemplify. And I mean, on the climate side, I'm hopeful that we as Europe can actually play a role in leadership. Individual small countries are already playing the leadership role. My favorite meme, I mean, half my team's in Denmark, half my team's in the UK. The UK had the most aggressive climate mitigation commitments until the last COP, where Denmark actually surpassed it. So we now have an inter-office rivalry going as to who will actually win. By the way, if we solve all the UK and we solve all of Denmark, we're still screwed. But at least we can play a role in actually being at the forefront of deployment, investing, capitalizing, and the Danish Sovereign Fund is one of my other large LPs, EIFO. So making these small countries bellwethers for what others can emulate around the world.
I think we have all it takes available. And there's a nice saying, where energy goes, where focus goes, energy flows. And I think it's not only a nice, let's say, combination with the topic we have been talking around climate tech, but actually when you think about the different countries in Europe, if you think about the different disciplines that are needed, from engineering over deployment, that are all required to solve that big problem. I think we have such a strong position in Europe that we can make use of when you think about having the geographic position we have, the funding, the democratic, let's say, environment to actually innovate and actually deploy capital in a forward-looking way. We just have to think about the positive aspects, the opportunities, and get them done rather than focusing on the negative and talking each other down.
Absolutely. Thank you for ending on that note. Exactly, Jan. Gentlemen, I hope you really enjoyed this episode. Everyone in the audience, I hope you did too. I am very committed to this mission of championing both the climate investors in Europe, but especially also the family offices that are out there building the next generation together with our VCs. Thank you so much for listening in, and thank you guys for joining me on the pod today. Before we start the show, a quick note. If you're building or running a fund, you know it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. First up, ACE Alternatives. Every fund manager needs clean operations behind the scenes. From fund admin to tax and compliance, ACE handles it all across VC, PE, private debt, and real assets. They're trusted by some of the best investors in the world, and if you want peace of mind and a scale-ready back office, ACE should be part of your stack. Finding deals and managing your portfolio is at the heart of running a fund. Synaptic helps you discover startups before others do, and Portfolio IQ keeps your portfolio data sharp and ready for LPs. Together, they're essential tools for modern fund managers. When it comes to legal, you need a team that truly knows venture. Haynes Boone supports LPs, GPs, startups, and scale-ups across the full fund lifecycle. Smart managers make Haynes Boone part of their stack. We have two at EUVC. Tech Barbecue. Oh my God, who doesn't love barbecue? Europe's startup scene meets the loudest, friendliest family reunion ever at Tech Barbecue. From Nordic founders to global VCs, this is where ideas catch fire and relationships get real. If you're building or backing in Europe, Tech Barbecue is where you want to show up. And hey, if you've got a big fun announcement coming up, want to hit the headlines, or just want to tell your story out, do reach out to us because we'd love to help. And we've got some killer partners to help you get in the right media places. They've helped us land Bloomberg, CNBC, Financial Times, Forbes, and many more for the EUVC Summit, and we'd love to do the same for you.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.